All right, everyone. Let's kick it off. So thanks everyone for coming. I'm Mike. I lead marketing at Ampla Technologies. We power commerce for consumer brands through capital, cards, and digital banking. And we're co-hosting this webinar with Vividly. And so we have Stu from the Vividly team here, as well as Craig, who is a mutual client of ours, and Greg Lopez, who is a fractional consultant in the finance space for a lot of the brands in our portfolio. So I'll let everyone introduce themselves and a bit about their company, and then we'll sort of jump right into the questions. And by introduce, I mean just the panelists. You guys don't all need to introduce yourself.
All right,
Vividly,
I,
you want to
I can.
oh, go ahead. Sorry.
I'll go first. Hi everyone, my name's Craig. I lead finance and strategy at MonkPack. MonkPack is a brand that makes 1 gram of sugar snack bars. We have a granola bar line and a nut bar line. I'm grateful to be here.
Cool. Thanks, Craig. I'm Greg, not to get confused with Craig. I'm a fractional CFO for a consulting firm called Aventus Advisory Group. We're about 50 folks. We specialize in accounting and finance solutions for businesses of all sizes, and not just focused on CPG and e-commerce, though that is an area that I have direct experience. I worked with Mike very closely in a prior life in our e-commerce venture called Gravity. So happy to be here, and thanks for having me.
Hey everybody, I'm Stuart, one of the co-founders of Vividly. My whole career has been in CPG, so breaking off and starting a software company was very much a tangent. I've worked at brands like Justin's, Perfect Snacks, and Lily's, owning forecasting, category management, kind of generally sales strategy. Joining each of those brands when they're pretty small, around 10 million in size, and then going through the fast growth experience to 100 million plus, and then selling to strategics.
Very cool. And so we have folks on the line that are sort of representative of like all different parts of the CPG ecosystem, from tech to consulting to the brands themselves. So I think you guys all have a really interesting visibility into the landscape. And so I wanted to start off with, even though the holiday season is really still well underway, I wanted to ask the team, and you could each answer this however you please. What are some things that have stuck out to you this holiday season? Any trends that are surprising, or predictions that you sort of saw coming? Want to just sort of open it up with that.
I think most of the reports have shown that Black Friday and Cyber Monday, which really kicks off like the holiday spending season, have been really big. I think that makes sense as consumers are looking for discounts. For us, MonkPack as a brand, we looked at it and thought to really compete as a brand in these holidays, you have to offer a pretty significant discount or a pretty compelling offer. And so I think most brands are trying to make the decision of whether they really do lean in on a pretty attractive discount, which would cost quite a bit to execute, or whether they pull back and do something lighter, but expect that the sales from the Black Friday and Cyber Monday won't be as significant. So that was kind of the equation that we were thinking through in our minds. And I think that's kind of where a lot of brands are thinking these days.
Yeah, I agree with that. You're seeing this happen right after COVID. The Black Friday, Cyber Monday period kind of extends throughout Christmas and New Year's, frankly. And people are starting to spend their ad dollars across that period rather than concentrate it specifically on Black Friday, Cyber Monday weekend. Across my clients, most of them saw just from weekend over weekend, just around a 20 to 25% bump year over year, which frankly, I was a bit surprised with. I thought the consumer might not be as resilient and as strong as it is appearing the consumer is. TBD if that's, buy now, pay later or credit card debt that's being racked up, but people are buying, people are spending, and the consumer still appears to be strong despite, some of the macro new headlines that you might see.
Yeah, and I'll just echo what Greg and Craig were saying. I mean, I think in general, we're seeing just more spending throughout the holiday season this year versus previous years. Just people are back out and shopping in retail particularly. And then I'll say from the brand side, just in general throughout 2023, a clear trend that we've seen is just small CPG companies just getting a lot more tech savvy overall, looking for systems, wanting advanced things like APIs connecting to, a BI system, something like that, things that I never would have heard our customers talk about 2 years ago. It's been pretty neat to see.
Yeah, very much. I mean, from the Nampla perspective, we've also been seeing strong growth for the brands that are on the platform while also prioritizing margin. I think discounting this year was pretty much flat. So the brands didn't seem to get, particularly more aggressive this year, and gross margin actually did jump, which to me indicates that promotional periods are either like tightening in terms of different offerings across the holiday season, not this big one-off 40% off for 2 months long. And I think that dovetails nicely into the next question is like, as you guys begin to think about 24, or I suspect most of the folks on this call have already gotten their ducks in a row for 24, what would you sum up being like the big 1 or 2 priorities that you're seeing the brands that you touch focusing on? And why do you think they're important?
Yeah, I could start with that one. So for me, during the planning cycle right now, I'm advising my clients to really think about, if they're not profitable, who's going to finance the gap? Do they have a strong lead on, equity, debt, some other means to finance the business until they can potentially get the profitability? And if they're already profitable, start planning around how we can potentially improve margin or eke out more profit. If you have a strong financial backer and you're focused on growth, right, then it comes down to a lot of folks just say, oh, the goal next year is to double revenue, but how, right? And that's the question. That's where the strategy and the real conversations and the hard conversations occur. Is it because do we double revenue by investing in marketing, investing in sales, investing in new product, right? Where do the investments have to be? I'll stop there and let the other folks answer, but those are the kind of narratives that I'm focused on when coaching and advising my clients.
Yeah, I can jump in. I think most brands in the last 12 to 18 months have really focused on getting to profitability or close. And I mean, if you haven't, I think that is a key goal to work towards. I think a lot of brands now are thinking about how to secure new investors in the future. And I think profitability needs to maintain, but investors also want to see growth. So, a lot of the hard conversations around how do we get back to the growth that we may have seen when we were spending a lot more without spending in the same levels. So, more efficiencies to get back to growth without sacrificing profitability.
Yeah, and I'll say 2 things on my side. One is just a best practice that I've seen throughout the companies I've worked at, where this time of the year is a good opportunity to, what I like to say, like grease the wheels a bit. Like simple things like the whole company looking at your calendar and saying, what are the recurring meetings that we actually need? And let's remove the ones where we don't have clear consensus that we need those. What are the systems that we truly need in place? All of those aspects, like this is a great time to kind of reset and really think about like, what should we be focusing on as a business? I think doing like a handful of things really, really, really well instead of like 10 things just okay, I think is really important, especially for, brands like the ones we work with where they're typically lean teams. I think the other side of things too is everybody's put a lot of work into planning at this point. You have your budgets in place, your revenue plan, all these projections. Anybody can put a plan together. Now it's time to execute it. So how can you execute that properly, and how can you start to ensure that the plan you put in place is accurate or not? You have all these distribution gain estimates, all these velocity gain estimates. Well, it's kind of time to put up or shut up and figuring out like, is the data actualizing how you expected, and can you pivot quickly? And what is your process around managing all of this? Like, I really see it as waking up Jan 1 and I'm immediately seeing like, okay, is everything that we did starting to look the way we think it's going to? If not, we need to start making adjustments and really being on our toes.
Yeah, and I think a lot of those themes touch on the next question, which is like, we've seen, and Greg and I went through this at Gravity when we were together, like diversifying away from a pure play e-commerce business, particularly for those that are focused on food and bev and those sort of like higher velocity items. Retail and wholesale distribution have become like a laser focus as both a means to like grow the business, but also try to get some profitability where while you're still spending at retail, it's perhaps not the same as spending on meta platforms. But what would you guys say, in your various experiences, like what are the big things to be thinking about for a brand that's new to wholesale or retail? And then we'll get into another question about like once you're there, what do you do? But like let's start with how what are the things to think about as you begin to approach those conversations with retail partners?
I think one starting place is what is the reset timing for the set that you're in, because decisions around what the reset is going to be like for next year could already have been made or are about to be made. So you really want to start plugging into when the retailers that you're reaching out to are making the decisions and when those resets take place. Beyond that, I think the big things are understanding the fee structure around these different retailers. You can think that a promotion is going to cost X, but by the time it gets charged back to you, it's costing more than you expected. And also getting supply chains in place for that. Like if you're a purely e-commerce business and you're working with a e-commerce fulfillment partner like a Whitebox or ShipBob, you'll probably need to figure out a supply chain to support retail distribution. So that would be another key thing to note.
I'll jump in here and say that I think one of the big things if you're just breaking into retail is to remember that you often kind of get one swing at the plate. You meet with the retailer, you get on shelf, now the real work begins. And if out the gate you're shorting the customer or you don't have a clear plan in place for how to grow your velocity, if you don't perform on shelf the way you're expected to, you might not get another chance to get into that retailer. So it's all about having the plan in place ahead of time to minimize risk and be as confident as possible in your ability to succeed. And I think one of these pieces is knowing what your capabilities allow as a company right now. Maybe, let's say Ahold says, hey, I want to do this big opportunity with you, like at all the registers. Well, unless you're 100% sure you can fulfill all of those POs consistently and you can execute, it's okay to say no. If you say no and frame it as, we want to be 100% sure we can support this and be a great partner, let's talk again in a year, you aren't burning a bridge. You're burning a bridge if you say yes before you're ready. And I think that's super, super important. And then also just ahead of time, you have a general understanding of how you're going to ensure that you're going to drive trial at the shelf, not just getting on shelf and crossing your fingers and hoping it works out.
Yeah, I want to touch on Stu's use of the word partner, right? There is this idea that when you talk to investors or you talk outwardly, that we're in Walmart, we're in Target, and they're a customer. But at the end of the day, they're really a partner pushing your product, and you need to be in sync with them. Obviously, making sure that the customer base is aligned. Whoever's shopping at those stores is also buying your product, that you're supporting the storytelling and the unique selling points of your product and brand, right? You maybe started on e-commerce, but your pack doesn't translate to in-store, which will affect velocity, right? And then understanding and hopefully getting a feedback loop around data sharing, transparency, inventory levels, customer insights that the retailer is seeing in terms of shopping trends, who's shopping your category, your aisle, and what you can deliver to them in order for increased sales, velocity, support to get the sell-throughs that you need to make them happy and keep you on shelf.
Yeah, and I think, Stu, this might be a good question for you, but like obviously staying on shelf and velocity is important. What are the tactics? Obviously, Vividly is known for managing trade promotions, but like in addition, please talk about that. But in addition, like what else have you guys seen in terms of interesting tactics that brands have been leveraging to sell through once they've sold in?
Yeah, sure. So from just a standard good old-fashioned trade side, I mean, that's a huge aspect. Running trade promotions is like one of the key levers for driving trial at the shelf. And I think we can kind of get more into specifics there later, but I think you have to have a trade plan in place that aligns with your budget, aligns with your growth plan. And what I mean by aligns with your growth plan is if you're looking to grow a ton in revenue, you probably want to spend a lot in trade. If you're looking to get more profitable, then maybe you don't want to just spend left and right to drive trial. Maybe it's a bit more intentional with each dollar that I think is important. I think other aspects, from Ibotta or couponing and different methods, like those aspects are also very important. And I'm seeing a lot of innovation out there around the couponing side. I mean, the good old days, you're dealing with these clearing houses with all these fees and stuff. And now we're moving more in the direction of, in my Apple Wallet, there's the QR code that I can scan at the retailer to get that discount. So it's all just about getting that person to try out the product. And I don't think you have to be very aggressive with it. You don't have to do a BOGO. You don't have to do a free offer. Just getting that tag on shelf can go a long way. And then the other piece that I think this can depend brand by brand, and sometimes it can work and sometimes it doesn't, but I've seen it work really well is being in store and demoing. At Perfect Snacks, we were doing more revenue through bars we were selling in demos than in all of Ahold. It was almost $1 million in business. We had a massive team of people saying, we know that our bars taste really good. If we can just get people to try it, we know we're going to succeed. So we invested heavily in that area. So just really thinking strategically about those types of aspects. Where do we want to spend our money? How do we want to spend our money? What is our strategy and how does it align with the way in which we want to grow the business?
Totally. Craig, I don't know if you have anything to add to that, given your expertise.
One thing I would say is for some retailers like Whole Foods or Wegmans, you'll get the data on how well you're selling from them. In most cases, you'll need to work with a syndicated data provider like Spins, which has a partnership with IRI, or Nielsen. And with that data, there is a lot you can learn from other brands. Like you can look at what other promotions have been run by other brands in a retailer and start to get a sense for the success of those promotions. There are some retailers that are training their consumers to look for BOGOs, and you might be better doing, a limited number of those per year than a more shallow discount. So there can be learnings from the syndicated data side, things too.
Amazing. Yeah, I think the next point, when we start thinking about trade and accounting for trade and accounting for these sort of activities, and this is perhaps best suited for Greg, like, what does it mean from a financial standpoint, once you start thinking about a wholesale first strategy, or at least a strategy that's more balanced towards wholesale? Like, I think a lot of folks have been accustomed to both forecasting and budgeting, based on an e-commerce world or a direct-to-consumer world. Like, what would you say is the primary difference once you start thinking about wholesale partners?
It's the scale and the margin. So for the scale perspective, you're talking about cash flow management, right? So understanding from your supplier the proper terms that you have. Do you even have the ability to provide? Oh,
Muting Grayson. Sorry.
Lost my train of thought, but talking about cash flow management, right? And then understanding, do you have the right partners in place to actually scale for wholesale, right? Because you might start as a test in a select few stores or region, and then quickly have the opportunity to expand, not necessarily fully nationwide, but more nationwide over time, right? So you have to have those redundancies and the ability to have that throughput from your manufacturing and supply chain partners. Additionally, what comes with that is you have to park more cash in inventory, typically in raw materials in your supply chain. And in some cases, if you have to add additional equipment, CapEx at your manufacturer to spin up a new line or a different line, sometimes they want to share in that cost with you, or they want you to bear the brunt of it, which means having your cash flow on lock, making sure you can afford to do all these big initiatives. And if not, start having conversations around, well, who out there like an Ampla can potentially support you? Do you need to go get a bridge financing from your current investor set? Do you need to go potentially raise another round if all of these prospects are going to come to fruition?
And Stu, there's obviously a big piece in managing the deduction piece as well, right? Like I think deductions and chargebacks are not necessarily a secret, but definitely were new to me coming from a pure e-com world. Like, can you talk a bit about the implications that can have on a business?
Oh boy. Yeah. Massive, massive implications. I mean, unfortunately, especially the natural channel and especially for small businesses, we live in a world where particularly UNFI and KE hold a lot of power and they make things extremely difficult on small brands. And if you want to verify certain deductions, then you get 200 PDF pages to manually sift through and they're emailed to you instead of something you can pull from a portal. And then aligning those to individual promotions can be extremely difficult. So truly understanding how a certain promotional event performed and how much it costs you can be difficult. Let's say I do a 2 for 4 in Whole Foods. I can go look at the Whole Foods portal and see, okay, it ran at the price point I wanted to, and the amount of volume I sold is generally accurate. Cool. However, you might have received deductions that were completely misaligned with that information, and what you ended up paying was significantly more. So, generally, just keeping organized around trade can be very difficult. And if you aren't organized with it, it can wreak havoc on your cash flow. I mean, the number of times I've had experiences where uh, we don't have a certain promotion planned, and then we receive a $60,000 deduction, and the whole company's like, oh my gosh, what is this? And it ends up being legitimate, and we didn't accrue for it. Like those can have massive impacts on companies that have thin margins, whatever it may be. So I think just having a clear instilled process for tracking each of these pieces is super, super important. And then the last piece I'll mention here is understanding the intricacies from retailer to retailer, distributor to distributor. For example, Whole Foods is going to charge you on that scan 2 days before they even put the tag up and 5 days after. So if you're running a 2 week promotion, you're going to get charged a scan for 3 weeks and they're just going to take the money. Or, with UNFI, they're going to charge you on their MCBs the absolute max markup. Maybe, your item costs $1. They're selling it to Whole Foods for $1.08, but that 20% discount is going to be on $1.40, and they're just going to pocket that. Understanding these intricacies is so important. Otherwise, it's going to be death by 1,000 cuts.
I think that brings us to a really important question, and Karen just sort of dropped it into the thread. Obviously, for certain categories, distributors are more important than others. And I know a lot of y'all have operated mostly in like F&B and sort of like wellness and natural. Can you talk about like just high level, like the pros of working with a distributor, like the instances where it's an absolute must versus the cons and vice versa? Like, have you worked direct before? Does that have its own challenges? I think that's an interesting point to spend some time on.
I can start off. We work direct with a couple customers, but we use distributors for a large portion of our wholesale business. They really do unlock the ability to sell into lots of retailers that we could not sell to direct. Also, if we sold to all the retailers that we sell to today direct, it would be a huge strain on our operations team to try to fulfill the orders to all those different places. So distributors really do help small brands get into a lot of retailers that they would not be able to on their own. But to what Stu said, there are some cons as well. They can be difficult to work with. There can be a lot of chargebacks. There can be a lot of fees. So I do think they are a necessary piece to scaling a food and beverage or other CPG brand typically, but you really need to understand how they work.
Do anything on UNFI insights specifically?
Yeah,
That's a question from
I was typing up a response there. I should definitely start with, I'm not super familiar with their deductions management tool. I would say that if it does break down the quote unquote confidential piece, then I think there is some value there. And for those that don't know it, a massive number of key retailers through Unify in their data, they just mark as confidential. This can be Walmart and Whole Foods and natural grocers, and so then you lose all that detail. If it provides some additional insight there, that'd be nice. I do find it a little hard to believe that they have a whole lot of incentive in providing clear information for you to understand what they actually do not, not what you actually owe them. But I'd be curious to kind of learn more about that. And then on the question around direct, indirect, in my experience, we were typically trying to go direct wherever possible, uh, partially because we were just getting around the markup that distributors had in place. So we could get to the same price point on shelf and lean in more on trade. So what we would typically propose when we'd be meeting with retailers, we would say, hey, like, here's how much we are going to have to pay to be able to get this product on shelf for you, and this is how much we'll be able to spend on trade. However, if we go direct, we'll actually be able to spend this amount on trade, and that's going to result in this amount of incremental units, which drives this much more revenue for you, and really make it a win-win presentation for them. Now, I think the other side of this is I feel like you have to earn to go direct in a lot of places. You need to get space in their warehouse. So typically you're going to have to kind of prove yourself out. And then as you grow and you're clearly a dominator in that category, you kind of have the right to get in and be direct. But throughout my career, I'd say as soon as we got over that hump and showed that we were selling well within that given retailer, we were always having as one of our key strategies to try to go direct. We could also have better data of what our shipments were, just a lot more things you can control.
Totally. The next piece I want to talk about is like metrics and KPIs. I think a lot of us that came from the direct consumer world are obviously focused on the big marketing metrics, and that's sort of, from ROAS to marketing efficiency ratio to, LTV, all that type of stuff. And I think there's a different way to be thinking about performance when you're talking about these retail channels. What do you guys what are you looking at when you're sort of reviewing performance at retail? What are the 2 or 3 big things that we think we should be focused on as we move to this more omni-channel world?
I can jump in on that one. Obviously, velocity and sell-through rate, super important. And then you have some other minor ones that you might want to take a look at: return rates, on-shelf availability, or any feedback you potentially gather either through the retail partner, or if you can independently gather some of that, post-purchase, or tie back feedback to your website if you have a digital presence. Incentivize customers to kind of visit you digitally and provide feedback for maybe a coupon on the next purchase, something along those sorts. But those are the big ones. You do lose, right, when you are selling through a distributor and you're selling your product through a retailer. You lose control. That's just the nature of it to a certain degree. So you have to figure out, almost by proxy, how you're doing if the retailer is not going to tell it to you direct.
The one thing I would say on velocities is, as an emerging brand, oftentimes you're not going to have velocities that are comparable to the legacy brands that have been on shelf 10, 20 years. So I think as you are gauging your own performance, looking at a competitive set of other emerging brands in the set is fair to do, at least initially early on. And that ultimately was probably going to be the story that you tell to the buyer, is of the emerging brands that they're having on shelf, you are having better velocities, or you are having more sustained growth, or something along those lines. The other thing I would say is that it's often easy just to look at brand level velocities and feel like it tells a clear story of performance in the set. But I'd really encourage looking at SKU level velocities to really understand the performance of your different products.
Yeah, I agree. Like on the velocity side of things, I would always implore our sales team members to ask their buyers, what are your expectations that you consider to be success? In Target, it might be 3 units per store per week, and in Kroger, it might be 4 units per store per week for the same item. So having them set the stage, and so then in your next meeting with them, you can go back and say, you mentioned that your expectations were XYZ in order for this to be considered a successful addition to your category. This is how we achieved those specific metrics. If we don't know exactly what the buyer considers good, then it feels like we're flying blind a bit. You know, you might be ranked pretty high within the category with some items, but you don't really know where they draw the line. So letting them kind of drive like what the KPI should be, I think is really important. Honestly, I feel like you could end the meeting if they're giving you the win with saying, what do you think my KPI should be in order to succeed with you at retail? The other aspect that is just super obvious is fill rates. If you have bad fill rates, you can be the top performing item, in their category, and they'll dump you. I won't name names, but I've had experiences where we lost really, really, really big retailers where we were, if not the top item, but a top 3 item or top 3 brand, and we were kicked out of the set because we had poor fill rates. So that was just so important. The other thing I'll just mention to finish this out is the second we get into a retailer, I'm immediately thinking about the next meeting and what is the story that I can be building to show that we succeed. Maybe your velocities aren't doing great. I might be looking at, hey, by inch, we actually have better velocities than this other product because they actually take up more space on the shelf, or our category share is growing more even though we're in less stores if you control for the amount of distribution we have. In general, this is where I think point of sale data just becomes so important. And investing as a small brand in a basic package or just one report or whatever it may be, I think is really important. And maybe even baking that into your P&L for that specific retailer, saying, hey, if we're going to go into Target and we're going to pull the trigger, let's make sure that we're actually willing to, get some data to make sure that we're making fact-based decisions.
Yeah, no, totally. I think that was a big, for us at Gravity at the time, we did a big buy at Target and ultimately like sold out the initial purchase order. But when we went back for the second meeting, or for the follow-up meeting, it was like, oh yeah, but that really didn't perform against the category the way we thought it was going to perform. So I think getting that level of expectation set up front is so important, and definitely was a learning for me. I want to be conscious on time and leave some ample room for QA. If anyone has any questions, if they want to drop them in the chat, I can pose them to the group here. So ask away.
We could also see them, I think.
Yeah.
Not so secretive.
Well, I know. Well, I want to gatekeep this, Greg. And if not, we could also, I have one more question on like trends and predictions, which are always fun. So maybe while we source some questions, the last to close this all out, like, what's the take for the new year? What do we think is in, what's out? Just a quick overview of what's top of mind for you all.
I'll say this. I think in the last 12 to 18 months, a lot of brands have really focused on what is the core that's going to get them to a significant size in terms of sales and profitability. So maybe they're saying, these are the 4 SKUs that we've really tested that have proven themselves. This is the positioning that's worked best for us. And we're going to take that, and that's going to get us to the point at which we can then start to experiment and, launch new stuff. So I'm excited to see what brands really focus on, and how they're putting their best foot forward.
I have a bold prediction for CPG, specifically in the food space. We've been on this health kick for extended period of time. I think people are going to want to indulge a bit more in the coming years. Not necessarily go back to, the junk food we're eating in the 90s, but be a bit more open, driven by, viral trends like TikTok, this, that, and the other. Not be so health focused all the time and always making the right choice, but sometimes making the fun choice. And I'm not saying, again, back to like hydrogenated oils and, trans fats, but something that's not focused solely on being healthy or high protein or low carb or low sugar. Sorry, Craig, but this is my own, bold prediction. I just think folks are going to head that way a bit more.
Greg, what do you think?
Yeah, it's a fun question. I think one aspect that I think is going to be changing fast, and which is a great thing for brands, is just innovation on couponing directly in the hands of consumers. Just right on your phone, maybe a link in your text, retailer automatically gets paid back, so on and so forth. So just really moving into the 21st century when it comes to couponing, I think is going to be really interesting. So then potentially shifting more and more spend away from, my national MCB with UNFI into these individual coupons to really affect the consumer directly. I think the other thing that I think is interesting is obviously a lot of companies did price increases throughout COVID. And I think a lot of brands found that the drop in velocity overall was not enough that they lost revenue. In fact, it actually might have helped them out. And I expect a lot of brands to see that and think, oh, maybe we can actually increase our prices even more and might get more aggressive in that experimentation, which I think will be interesting. And I think with that, are companies going to hit a price cliff and then they're going to find out the hard way that their velocity plummets, or are consumers just generally not very price sensitive at all and they'll keep paying it? I'm not sure. But the cost of a dozen eggs right now is crazy, and I know their velocities are not dropping. So it's interesting.
Stu wants more inflation. Stu,
Yeah.
not for president. Just kidding. I know the
I
president
mean, I
would
would
call
vote.
that.
We have a couple. Karen has a question and has asked to unmute.
Yeah, I mean, I think Vividly should be able to run price elasticity studies to see how high we can go with our pricing. So the retailer doesn't get all the margins. I dropped it in the chat. I was just on a call with Crisp and how Crisp is kind of taking over the unified portal and their insights and how they clear deductions and stuff. And Stu, I'm just wondering if you could give me your take on that piece, since we are Vividly, I'm with Wild Planet, we are a Vividly customer and we love it. And I just feel like it's kind of duplicating the efforts that we have with Vividly and paying Unify more.
Sure. I'll start with, I think in general, huge fan of Crisp. I think they do a lot of great things. Great at just sourcing a lot of different data, cleaning it up, making it visually appealing. Really love what they do. I think, with Unify particularly, Unify, I think, just doesn't have the biggest incentives to provide super clean data, especially when it comes to deductions. My understanding is the data that they'll give to Crisp still doesn't, break down that confidential piece, as I was mentioning earlier. And for me, that's a super important aspect. I think there's like a dozen key top retailers in the nation that fall into that confidential bucket. If I can't break that out, it's pretty frustrating for me. I think the other aspect with that is I think there's definitely some duplicative work in terms of like what our capabilities are and what theirs are. Like our deduction scanning machine learning tool versus kind of where you have to load in the file and select all these different drop downs in theirs to kind of fill out the information. I obviously am a bit biased here, but I would say I think our side on understanding and breaking down the complex deduction backup is a lot cleaner and more advanced.
Agreed. I just wanted your take. And I totally agree on the confidential piece. Like that's, a lot of their key customers are confidential. And if you can't connect the deductions with it, then there's no point in having it.
One question from Aaron Wallace. Any trends, re-promotions, e.g. more frequency versus depth, etc.?
Good question. I would say that, and I guess I want to be clear, Aaron, that I haven't like gone into a bunch of data and seen if I confirm the trend, but what I hear is generally a lot of customers being super intentional about the everyday price that they want to have on shelf. And because you have these varying costs by DCs and so on and so forth, there's a lot of EDLPs going on in order to achieve, I want to be $3.99 in all of these different stores all across the board. It does also seem that retailers try to steer the ship as much as possible in terms of the types of discounts you're running. If you're an Ahold and you can get away with not running BOGOs, that's awesome, but generally they're going to want you to run BOGOs. So I think pretty often you're going to have to sort of do like a pay to play and do what they want to do. However, the more you can go into those types of discussions and have fact-based discussions and show actually, hey, if I do this instead, it's going to be better for both of us. I think that they're definitely open to that. I would say that the best in class brands that I talk to do every single thing they can to not over discount the consumer and have too high of a frequency of their trade promotions. It's literally the goal of, I just want to get a tag on shelf to catch their eye. And if that's a 10% discount, cool. I don't need to go super deep, and in fear of training your consumer to only buy your product on deal. I think this is especially important for products that cost a lot of money, and you're going for kind of like the Whole Foods type consumer that's less price sensitive. If you're just overly discounting yourself, you're kind of just eating into your own margins for no reason. I would say the one trend that is very clear is greater and greater desire and expectation for small CPG companies to run like a big CPG company in several ways. Individual customer and product P&Ls, detailed budgeting expectations, those sorts of things, where I feel like a handful of years ago, it was not like that at all.
That's that answers it pretty well, I'd say. All right, everyone, thank you so much. We'll wrap it up. I think if anyone has any questions for the panelists here, I'd be happy to connect. And if you don't know them already, yeah, I'll make that happen for you guys. Really appreciate the time. If anything pops up, shoot me a note. We'll get you connected to whoever you'd like. Thank you all. Appreciate the time.